trickling in. Before we get started, I just say there's a lot going on. As usual, though, if you have any questions, please text them in, and our board members will look at them, or myself or Sadie will check them out, and we will try and answer all your questions. We have a number of distinguished board members here from various different banks, and which gives us a great opportunity to get a point of view from some of the smaller and larger banks. Before I turn it over to Leticia to get it started, I just want to say there's a lot going on in regards to the reopening and COVID-19. We will try and get you information out, and we consistently over the next week or so, it'll be changed. CARES Act has put some money together, and our governor has that will trickle down to prospective tenants in need. They'll have to apply for that, but like all the systems put in place, the unemployment, which is getting slow because they don't have systems in place to handle the volume. It took the banks a little while to get around the PPP, although it appears to me that the banks will end up looking better than everybody else in regards to how they put the PPP together. And this will be called the WRAP program, WRAP, Wisconsin Rent Assistance Program for Needy Tenants. It'll be on our webpage where they can go and apply to that. So once again, I hope everybody is safe. And again, we have a great panel here. And Leticia, I'll ask you to kick it off.
Sounds good. Well, thank you everyone for joining us. My name is Leticia Schwengel, and I am a commercial lender for U.S. Bank. I am also a board member for the Apartment Association of Southeastern Wisconsin. And I am joined today by Wes Walsh from Tri-City Bank, who has extensive commercial lending experience as well. Heather Nelson from Spring Bank, also a long-term commercial lender, lots of experience there. And then Kobe Hackler, and I apologize if I mispronounce the last name. He is with our U.S. Bank Mortgage Group. And so our intent today is just to ensure that we keep our members aware of what we're seeing as lenders, specifically over the last couple of months. I will say that quarter one started off very, very strong for me independently as a commercial lender. We are very experienced in investment real estate, from a single family investment property to a multi-unit apartment building and any type of commercial and mixed unit type of property. Again, quarter one, very strong. Interest rates were attractive. Then, come March, we were hit with the coronavirus COVID-19 pandemic. And that definitely took a shift, I think, for everyone in the industry. There has been a lot of activity on the government side to ensure that our business owners are being assisted in some capacity. The bank has been spending a lot of time working on PPP requests and fundings of those loans. I personally have not had a lot of activity with PPP because a lot of the customers that I work with are independent real estate investors. And so my job is just, over the last couple of months, has been to kind of check in with my customers, see how their properties are performing, see how their tenants are responding to whether they're paying rents, to the current unemployment crisis that we have that are facing a lot of these tenants. And we have tightened it up a little bit on our lending. We are being more cautious. We are definitely still financing, but we are financing for the right individual. And what I mean by that is we are looking for stabilized properties with historical performance. We are looking for strong loan to value. We are looking for strong credit, strong liquidity. And we are doing a sensitivity study on each property just to ensure that if vacancy were to increase or the real estate market was hit further, we would be able to sustain and continue to hold on to that note. So again, we are still interested in financing. Rates are extremely low. I think the lowest, at least I've seen it in my career. And we review each individual case by case just to see whether or not it's something that we can take on. So that's kind of what I've been doing over the last three months, is just maintaining conversations with my customers, ensuring that if there is an opportunity to help them refinance something, that we can do that. On the purchasing side, I have not seen a lot of activity. I have seen that a lot of our out-of-state investors that would come in and buy package properties here in the city of Milwaukee have actually held back from moving forward because, again, the uncertainty of whether the cash flow will continue to be that strong or whether or not the values would continue to stay strong. As far as the values of the properties and the appraisals, all of our evaluations and appraisals are now required to have some kind of COVID-19 writing on it to indicate what kind of impact the virus has had or could have on the value of the property. Some appraisers are not able to go into the buildings for obvious reasons. Appraisals are taking a little bit longer than expected, so our buyers are, advised to ensure that we are giving the bank enough time to be able to get the financing in place. So that's kind of what I'm seeing. I'll turn it over to Heather and kind of let her know or allow her to share with you guys what she's seeing in the market. Heather?
Thanks, Leticia. I think basically what Leticia has said is the same thing we're seeing. The difference for me is that I've been working with both real estate and small businesses for many years. So I did spend quite a bit of my time working on the PPP loans for a while. And with the information coming out very scattered, it was difficult for clients to get a grasp of it and difficult for us to handle all the influx of business in that short period of time. Now, obviously, things have slowed down a lot with the PPP and there are still funds available, and fewer people have been applying than had in the past because I think most people have applied for that. Again, the changes as of recently also have been beneficial to the small businesses, allowing them a longer period of time to have access to the funds for them to be forgivable and access funds for rental purposes, which tends to help a lot of our mixed use real estate clients and other clients that had retail space due to the fact that they're just starting to open. And now of the PPP funds, 40% can now be used on rent and utilities, which has allowed them to switch some of their allocations. So it has helped some of our also customers who own real estate and mixed use or retail businesses. It's been a little bit helpful for them. Interest rate rise, I think what Leticia said is correct. Interest rates have dropped significantly. So we're seeing a lot of people out there refinancing and restructuring what they have. New purchases, again, everyone seems to have slowed down a lot. I think just anticipating what may happen, appraisals have been coming in very similar in all of the Zoom conferences on commercial real estate, both multifamily and a lot of the industrial, all have continued to come in strong, and everything that I've heard continues that way. I think I was listening to something that said it was like 12 million units, the payment rate of rent, only the non-payment rate only went down by 1% in comparison to last year at this time. So multifamily has not been hit quite as hard as some of obviously the retail space and office space has with non-payment. So we tend to be still looking at those. Like Leticia, we are asking each client to inform us as to how they feel COVID might be affecting this property going forward if we're refinancing or if it is a new purchase. And we are also asking the appraisers to make sure that they look at that when they are putting our appraisals together. So that I'm basically on the same page as Leticia. Things did slow down quite a bit, I think, because people are just being very cautious, and things are taking longer. All the processes are taking longer because for banks, our underwriting is taking a little longer because they are looking at COVID, and that's something outside of the norm. So it's just taking longer to put the procedures in place for that. And then same with the appraisers, because they're used to getting into units and seeing things, it's a little more difficult for them, and they have to do a little more back work if they're not able to get into some of the units. But I think that's it, Leticia.
Okay, perfect. Wes, why don't you go ahead and talk to us a little bit about what you're seeing, your experience, and what you're seeing at Tri-City?
Sure. So I think we're probably somewhere in between, maybe a little bit closer to Springbank and what Heather's been doing. We were very involved in the PPP loans. That's been almost everything for about a month and a half there. Prior to that, when the first round of COVID stuff hit, it was tons of payment modifications. Because I work with a lot of our owner-occupied small business owners in their real estate, along with a lot of the retail strip centers, office buildings, things like that. We did those modifications for, just trying to help them out as much as we can. Then yeah, the PPP stuff hit, and that was everything for a while. And now we're kind of coming out of that, at least with just the forgiveness stuff to go. Deal flow is slower than usual, I would say. There's still stragglers out there, and I think the bank is still doing deals, but with a little bit of extra scrutiny, a little bit of extra underwriting that maybe we wouldn't have done in the past. One of the big shocks that I noticed is, and would probably apply to a lot of the multifamily owners in here now. We've started doing as much as we can, due diligence and tenant underwriting for multifamily properties. So, and that varies from property to property, how much information you can get. But we would like to see, if available, some at least employment record or evidence of where these tenants are working, so that we know we're not financing a 16-unit property and 14 of the tenants worked in food service, and now we're out of work, and unemployment's covering it for now. But then what about in 3 months if they're not back at work? I think that's the biggest risk in the multifamily area. So that's what we're doing to try to cover that. I think that's probably a concern that the investors should share along with the bank. I don't think that's an unreasonable request, and as long as it's reasonable, we'll still do the deal. But that's just that was the most surprising thing I think I've seen in our new underwriting world that we're in. Otherwise, yeah, it's just tightening everything up a little bit, like Leticia said. Maybe the days of the 80% LTV, 25-year AM, that's over for a little bit. It's just not going to be there. You just might have to come in with a little bit extra cash, because the bank is scared just like you are. So that's kind of where we're at.
All right, Colby, you want to talk to us a little bit more about the mortgage side of the business, just to kind of share with the members. So Heather, myself, and Wes are, again, more on the commercial side, which typically structure things, 5 over 25, 5-year terms, up to 25-year amortizations, and somewhere in between there based on the type of property and client. But Colby works with the mortgage group, and many of you know that you can own investment properties under your personal name up to a certain number, I think, per bank, and that's more traditional 30-year fixed mortgages. And that's where Colby kind of comes into place to share about what he's seeing on that side of the market. Colby?
Yeah, thank you, Leticia. And first of all, I didn't realize how much gray hair the camera added, so I just want to preface that. Yeah, what I kind of liken it to is, if you're in the middle of the storm in your boat and you didn't make the proper preparations before you left harbor, you're going to sink. And I think one of the things that we've done a good job of at US Bank in particular, but I think in the residential lending business overall, since 2008, 2009, is we've put a lot of things in place that prepare us to get through a tough time like this while still keeping the lending doors open, so to speak. So we're still lending. Rates are incredibly low. We had a record year last year overall at US Bank. We did, I think, 31 or 32 billion dollars in originations. In no single day last year did we ever receive 1,000 applications. This year to date, we're averaging over 1,000 applications a day. Now, granted, most of those are for primary residence homes and second homes and whatnot, but we are still doing a lot of lending on investment properties. We allow up to a borrower to have up to 4 investment homes, and of course those are 1 to 4 units. And we've really not done much in terms of changing our lending guidelines. We've added some verbiage for folks who might be in forbearance to make sure that self-employed borrowers are still receiving some sort of income or have some sort of activity in their business up to 5 days before closing, which is something we didn't traditionally do. For self-employed borrowers, another change is we used to ask for just previous years, either tax returns or profit and loss and balance sheets. Now we're asking for year-to-date profit and loss and balance sheet. We want to see that a self-employed borrower, whether they're financing a primary residence or a 3-unit investment property, we want to see that they're still working and generating income. We want to see that if they're in forbearance, that they're making their payments. We've made several adjustments there from FHFA with their direction. But by and large, we're seeing a lot of activity in the market. We're seeing a lot of people paying cash for properties. Obviously, they don't need us when it comes to those kind of transactions, but I'm fully in touch with the realtor community. And the realtor community is seeing a lot of cash transactions, both in primary residence and investment properties. Despite the large unemployment numbers and the scariness that abounds, from pretty much every direction you look these days, there seems to be a lot of action in the real estate community, especially in Wisconsin. And I work in Illinois, and Wisconsin seems to the most active in the last, and a testament to the value in the real estate market there, and to just the way that the state has handled this whole pandemic. I think we're going to continue to see a lot of activity, a lot of buying and selling of both residential, primary residence, and investment properties.
Kobe, I think we lost you for a little bit there.
Yeah, I think I'm back though. Sorry about that. And I think that we're going to continue to lend. We've U.S. Bank specifically through the last I would say 25 or 26 years has posted profits in every quarter, and that includes during the mortgage meltdown. And that's because we've always done things we feel the right way, and we've done things with our customers' best interests in mind. And from what I'm hearing from Leticia and from Heather and from Wes so far is that this is a time when banks are just getting a little bit more scrutinous of the deals they're doing, putting a little bit more pressure on borrowers to come up with documents, to come up with evidence that they're solid, worthy borrowers. And I think what that ultimately does is when you go through something like this, even though this thing in particular is unprecedented, but when you go through something like this, it actually puts good pressure on the real estate market as a whole. It puts good deals out there, and then in years to come, when things loosen up, there's enough of a healthy product out there on the streets, both from a lending side and a real estate side, to keep the market flowing properly. So I think what I've been seeing in Wisconsin, at least from U.S. Bank's perspective, from the commercial side and the residential side, I think we've seen a good, healthy approach to this with putting customers' needs first, and making sure that we as a bank can continue to keep the purse open and lend, even though that purse is a little bit tighter than it may have been last year. So that's my perspective from the residential
Okay.
side.
Ron, we just received a question, and just for all of our members, there is a chat option on the call that you can certainly post your question, and we will try to answer those as they are coming through. One of our members asked, how are the protests impacting the Milwaukee market? Heather, do you want to tackle this one? I know I personally have not been made aware of at least my clients being affected or their properties affected by the current protests. But have you heard anything? Have you seen anything?
I have had some customers who were affected, who had some retail and some mixed use properties. But they've all had insurance and been able to move forward with things. Obviously for some of the ones that were closed, it was difficult because it was at a time where they were just starting to reopen. So it was a little bit difficult for them and an added stress. Again, I don't think that has anything to do with the protests themselves. I think it has to do with some bad apples that were taking advantage of the situation against some of the customers.
Okay. Wes, have you heard anything or seen anything from your customers?
Not any stories of damage or anything like that. Fears, yes, but nothing that's materialized.
I think one other point too, at least what I've heard from other peers in the industry, is that a lot of the impact on the properties, whether it's the ability to collect rents, vacancies, or potential evictions, a lot has to do with oftentimes where the properties are located. Like Class A apartment buildings are definitely standing a little bit stronger on the collection side in comparison to maybe more inner city Milwaukee properties. Is that kind of what your thoughts are on how the properties, depending on where they're located, are also being impacted?
I think it has to do with the message too. I mean, I think the Apartment Association had put something out basically to reach out to your tenants and things like that in advance. And I think a lot of the clients who did that were ahead of the game. And so they had a better perspective. And I think a lot of the tenants work better with someone who's willing to work with them instead of when they're behind, it's always a little more difficult. But I think if you catch them up front, you do a little better. So most of my clients have been doing pretty well with collecting their rents.
And I'm speaking to that.
Go ahead, Ron, sorry. Go ahead.
What I'm hearing from most members that I talk to is that there are a select few. I'm going to start my video here, or at least attempt to. There are a select few that haven't paid, and the tendency on that is when you owe somebody money, you tend not to answer the phone. But for the majority of people I've talked to, their vacancies are low. So in other words, their occupancy is high, and they have a few outliers that aren't paying. So I think in many cases, they're doing as well or better than they have in years past. Now we will see what happens June, July, and August. The longer this stretches out, hopefully, people will be back to work, and the funding that the state has provided, the RAP program, although $25 million sounds like a lot of money, it's not a lot when you divvy it up. So far, people I'm talking to are doing pretty well. There's a question here on interest rates, and I know bankers hate to answer that question because it's an ever-changing thing, but at this point, and it depends upon your credit, we have somebody asking about a 800 credit score. What are you hearing what are your interest rates? I mean, and Kobe, I would jump on that also. You say you're getting 1,000 applications per day. Is a lot of that refinancing?
I would say right now, about 75, maybe 70 to 75% is refinancing. Yeah, and And we're seeing, rates on a 15-year fixed as low as 2.5%, high twos, low threes on a 30-year fix. I mean, the refinance volume is unprecedented, just because of that. But we're still seeing steady values when it comes to the homes being appraised. And despite the unemployment numbers, we're seeing that many people applying who are working and earning money. So, there seems to be a disconnect between the financial meltdown that we're seeing on the news every day and what's actually happening on the banking side.
So the numbers you're quoting, Kobe, are homes, correct? Residential.
Correct. Yeah, I mean, if you're buying, for example, a 4-unit investment property, instead of getting 3 or 3.125%, you might be getting 3.5 or 3.75. But still, unbelievably cheap money when you're talking about borrowing hundreds of thousands of dollars.
Is that generally like would everybody agree about a 5-year lock on something like that, or 3-year, 5-year, 7-year?
At least on my end, typically the most that I can extend if it's a non-owner occupied commercial property is 5-year terms. And again, our rates change on a daily basis, right? But I think right now we're probably quoting anywhere from 2.75 to 3.5. It just depends on the relationship with the bank. It depends on the type of property. There's a couple of different factors that go in. Oftentimes, even though we may be the most attractive on the interest side, we may not be the right bank, right? Because we are very specific on the type of properties, the cash flow that we require, where maybe other banks are more open to loan to value and the collateral and things of that sort. So I think, our members should definitely have conversations with, I think, multiple commercial bankers just to kind of see what the appetite is for each individual bank. And then, it's not always about rate, but rates, again, are very extremely low at this point.
So, not to confuse everybody, but Susan is really Heather.
Sorry.
We'll ask Heather and Wes the question that somebody has put in here. Darrow's asked, I've been trying to refinance a 40-year 7.7% mortgage for a long time. I have good credit. I'll ask the two of you to read it and jump in and give your thoughts on Darrow's question.
So I guess we're looking at a maximum of 20 years. Sometimes we go 25-year amortization. That's kind of where we are falling. And again, we're probably for sure of the banks out here, we're the smallest community bank. So we have a lot more flexibility on the types of deals we do. However, our interest rates are going to be higher, again, because we don't have the deposits to be able to lend out. So our rates are higher. So like Leticia said, we have flexibility perhaps on loan to value, credit, things like that. We have a little more flexibility than some of the larger banks, but our interest rates will tend to be a little higher. And for the term, we're really not looking more than 25 years as an amortization, 5-year fixed, 20-year amortization.
Well, he wants to pay it off in 10 years, but if I understand another part of his question, he has an appraisal from March. But if I'm correct in my understanding, most banks want their own appraisal. They won't use one unless it's an appraiser they use.
Correct. If it was done for a bank and it's an appraiser that is on our approved appraisal list, we'll use it.
Wes, you got anything to add to that?
I think I would echo a lot of what Heather said. We're very similar on a lot of that stuff. We kind of probably fit between Spring Bank and US Bank, more towards the Spring Bank end as far as our size and our capabilities like that. I thank Leticia for not trying to steal all our deals with that 2.75% rate. We're not going to be there. We'd probably be mid threes to high threes for a good deal now. But yeah, nothing that they didn't cover there.
So we have a question. How do we get a hold of these speakers?
I know Sadie sent out the invitation, and that has our names only, I believe, and our description of our bios, but it does not have our contact information. What we can do is we can put that information together and send that over to our members so that they have our direct information. That work for everyone?
Yep.
I think the one other important thing to touch on Daryl's question was that although he's looking to pay off the loan in 10 years, when we as commercial lenders analyze an asset, in this case, the property, based on the income of that property is how we can determine whether or not this is a loan that could potentially be paid off in 10 years, right? So even though your goal may be to pay it off in 10 years, maybe on the lending side, it only works on a 20-year amortization schedule based on the income the property is generating. We always want our properties to perform on their own. We don't want to rely on the income of our guarantor or income of their additional business or other properties. We like to focus on the asset more often than not. And at least for us, we typically require $1.25 of income for every dollar of debt. So debt service coverage ratio of 1.25. I think that's pretty similar to what maybe my peers look for. You guys want to touch a little bit on how you analyze a transaction and see if that can be helpful to our members?
Yeah, I think we're right there with you. Right now, into the circumstances we're in, some of that stuff kind of gets thrown out the window, and it's a lot more focused on who the tenants are. If we're talking multifamily, like I said, we'll probably try to collect some information on the tenants. Otherwise, if it's retail or something like that, it's going to be a lot of tenant underwriting more than anything. We can look at your historical cash flow statements, but if we forecast that there's going to be some significant rent non-payment or vacancy issues here in the future, that can affect that drastically.
Heather, anything that you want to add to that?
We're basically at the 1.25%. And again, we're looking at things more deeply than we have in the past, just because we want to make sure that that's not the only number. It used to be the key number you're looking at, but obviously we're looking at the loan to value for that to be in a stronger position at this point in time too.
So Heather, just to clarify, when you say 1.25%, you're not quoting rate.
No, 1.25 times coverage is what we would look for.
Yes. Are the panel members comfortable with this statement? Generally, smaller banks can offer a little more flexibility than larger banks.
Yes.
Okay.
And the good thing about, I think, commercial lenders is that there's a handful of us, right, in the city. So when you're presented with a deal, I know Heather has sent deals over my way, and I've done the same. Sometimes if we know it's not the right fit for our bank, we typically do have a contact that could make that deal work somewhere else. And so we're always willing to give some kind of answer or feedback to our customers to make sure that they get their hands on that property or the ability to take advantage of refinancing, even if it doesn't work for us.
So we have a question. Is anybody doing construction loans?
We do not do construction loans on our side.
We do them on the residential side, but not for investment properties. So if you're building a second home or a primary residence, we'll do a single close construction loan, but we won't do them for investors or speculators.
I have some that started before all of this. I haven't honestly had any new requests for any construction loans since the COVID thing started, but I do have ones who were in the middle of construction during all of this.
Yeah, and we've always been pretty good at the construction deals. We like that stuff a lot and try to keep it permanently, but we do a lot of the temporary construction financing. I haven't got one approved like Heather since this all started, but I'm taking one to our loan committee on Thursday, so I'll get back to you on that.
Good luck.
So that appears to be all the questions we have. Once again, we will send out video on this to all our members, and you'll have an opportunity to do it. We will also get contacts for everybody on our panel. I want to thank all of you for participating, and stay safe, and everybody take care.
Thank you.
Thank you, everyone.
Thank you.
Bye-bye.
Bye.